Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, we're back here on the Investor Coaching Show. Paul Winkler, Evan Barnard, and Dan Hill talking money and investing. All right, guys, what do you got? What do you got? You guys go.
Just to follow up that comment you made about international, and how it pretty much correlates to U.S. large, and so having gone to Nerd Camp, and I always told people even before Nerd Camp, Evan told me about they were doing it because it's we're big on the academics.
I love it, Nerd Camp. It's just
that was
so
a great name because I always told people they call me a nerd. I said, no, you want to meet some nerds, you need to meet Evan and Paul. They make me look like a normal human being. So I just
got normal, back. Dan. I'll vouch for you.
Yeah, that's a different story. It's a different show. So I went out to represent the company in Nerd Camp, and we took a deep dive into the fund company that we use, was to really go on PhD level, your kind of level, Paul, and then Mark brought it back down. But just, the diversification we have based on the science, based on 70 years of academic research, based on Nobel Prize winning economics. And as you just said, 99% probably of the portfolios we look at are overweighted U.S. large growth. Why? Because we're Americans. Okay.
Yeah.
Baseball, apple pie, Chevrolet. Right. So going full circle about just teaching, when you talk about teaching a guy about munis and how we try to teach, but why we do what we do, why their portfolio is diversified like it is. And so one of the things that we use in our office, I'm sure you use it too, is the Callan chart that has kind of like the chemistry periodic table from your old science class.
Yeah.
That has like who's the winner. It's different color code. And if you look at that every year, it's a different color that's at the top. Sometimes
so those of you who don't know what the heck he's talking about, it'll go through different countries. And it will list, what do you have, a couple dozen countries probably in that thing.
And asset classes. Yeah, and the asset classes.
And you have it for asset classes too. As an asset class would be large growth companies. Another asset class would be small growth companies. Another asset class would be small value, which would be smaller distressed companies.
Both U.S. and international.
And then you do it, international small, and so on and so forth. And in any given year, you will have what is the top area of the market. And it'll be large value one year, and then it'll be small value the next year, and then it'll be large growth the next year after that, and it'll be international large, and it'll be international small, and then it'll be U.S. small value, or, it'll go back and forth. And because they color code them, it is pretty.
Well, it's really easy to show people, though, that the color, that the top line color is different.
Yeah.
Almost every year. And the color that's at top one year may be at the bottom the next year and vice versa. Okay. So that goes back to your, basics of buy low, sell high when we rebalance. But so we are diversified. We're all American. Everybody wants U.S. large growth. So last year, our international fund was up 43%. I think.
Yeah,
the core fund. Yeah.
Almost 3 times what U.S. was, and it was up 13%, which is an awesome return. But when you look at the factors that we also teach about, the 3-factor model, which is now morphed into the 7-factor model, it's a whole nother story. But it's you need to be diversified, not just in large, but in small and in value. And the international small value fund last year, that's in our portfolio, that most mutual fund companies don't even have.
Or don't have a very good representation of.
Right. Some don't even have it. They don't even have it in their menu. And they have 2,000 funds and don't have that. That was up over 50% last year, okay? And it's because of the academics, we tilt to small and we tilt to value. So we're grabbing 2 of those premiums when we buy small value. And that thing just...
And you just don't know. Year by year, you don't know. And even though the expected return, we say expected return long run is a certain amount, you just don't know when those returns are going to appear.
You have to be on the train when it leaves the station.
So, absolutely.
To that point, Paul, so Nerd Camp brought that out. What are the 1, the 3, the 5, the 10, 15, 20 year? And those premiums exist at about a 2% premium for owning small companies, to about a 2% premium from owning value companies, i.e. distressed companies. And so that was really the stuff I like. I'm a math guy too. The numbers are showing that premium does still exist. And the data proves it. So it's like I have to get this coffee cup, one of my coaches. In God we trust, all others must bring data.
All others bring data.
Yeah, and that data's out there, and it makes me feel good about what we're doing and teaching, what we're teaching people.
And that's the thing that's so, for me, was logic. It just made sense.
Yeah, you can't argue it.
That way, because so much of, if you look at the decision-making of individuals, one psychologist put it this way. He says 100% of financial decisions that people make. I mean, that's a pretty high number. I mean, some people say it's 90+%, but this one guess, no, it's not 90 something. It's 100% of the decisions we make are emotional in nature. And we don't think of that as emotional. We think, oh, well, I really like my advisor. Oh, bing, emotional. I've been with them forever. And loyalty, emotional. I really think that they've got great commercials. Now, not too many people do that, but there's some of that. But, I really like my banker. I trust my banker. Well, they're emotional, trust. So often we just do that just because we're like, this is over my head and I can't do it. And that's what I hate about rating systems, quite frankly, online now. My wife and I will hire somebody. We need to get somebody to do drywall work, or we need to just have somebody do painting around the house, or we need to hire somebody to do fencing or tree removal, or that's a big thing now, right? Tree removal. Yeah. There's a lot of you out there dealing with that, right?
That was the train to be on.
Yeah, for sure. And for me, it's just, this one has 5-star rating. I was like, honey, that they can whitewash and they can get rid of all the bad ratings and they can just bury them. And that's exactly what people that run businesses do. The ones that know how to do it, will do it. The ones that don't know how to do it, hire somebody to do it for them, right?
Or go out of business.
Yeah, or go out of business. Yeah. And then there was this whole scandal where you had companies rating their competitors, giving them low ratings to drive them out of business. Restaurants, that was a big deal. They got terrible food. I got food poisoning when I went there. They'll put stuff like that that's out there that's fake.
Right.
And you can't trust stuff. So my point of view in this is you've got to trust yourself. You've got to understand not everything. We'll let you know as much as you need to know, but you can't just blindly trust somebody's rating. You can't talk to your friend. I had somebody tell me the other day, I said, they were asking me about Social Security. This person tells me this. My friend was asking me about Social Security. And here's what I said. And I said, that's wrong.
Those are always fun conversations.
Those are bad information. I've got a workshop on paulwinkler.com. Have them go watch the workshop on paulwinkler.com. And that's actually wrong. But it's a common myth about Social Security.
Yeah.
And that's unfortunate. And I had that late 90s. Everybody's telling me I need to go talk to my friend's financial advisor. And and I said, well, what were the returns, right? And I said, well, this is what our returns were in this year, 95, 96. And because if you look at somewhere in the neighborhood of 92 to 94% of your return is, 95 was what FAMA said. The amount of return that you have was due to, the asset mix that you have and the asset class that you're actually exposed to, and your factors drive that. Well, as somebody tells me what their return was, I could give them a pretty decent idea, what asset class they held. If you told me your return last year was 52%, I'm telling you had all your money in small international value stocks, right?
Yeah.
And for the investor, when they're talking to a friend and they say, my friend's really great. And you look at, well, what were the returns? And you go, in the late 90s, I knew that they were very heavily exposed to tech.
Right.
And then all of a sudden, their friend's financial advisor became the worst advisor ever in the next 3 years, 2000, 2001, 2002.
Right.
But before that, it was what? Emotion. What was the emotion? Greed.
Right.
Or the emotion is fear. Harry Dent,
Yeah.
that type of thing.
And we are bound by our environment, right? And so we're talking to American clients, and we're American, and we live in America. But behavior, emotion, trust, loyalty, those are universal emotions. And I was on vacation this past week and was talking to a couple of advisors.
What's that like anyway?
I know. We landed last night like at midnight. I'm still recovering. But
Oh, wow.
I wanted to get back for the show. But
I love it.
This guy had what was an equivalent of an RIA, Registered Investment Advisory Firm in North London.
Oh,
And
okay.
both these guys were from the UK. One actually worked for not Goldman Sachs. Jamie Dimon's company, JP Morgan Chase. And but this gentleman, his wife worked with him in the practice, and they used to have commissions in the UK, and then got rid of them. I think in 2018, and so he was in the industry.
Banned
with
them.
Yeah,
You can't give it financial
now
advice
it's
and receive a
fee
commission
only
now.
and
Right.
all this kind of stuff. We were talking about some of the practice management. Just I'm still on vacation talking about practice management with some advisor in England, right?
So you don't know what a vacation is either. Okay. I feel better.
I have no social life. But we talk a lot about when we see a portfolio come in from a client, it's heavily weighted in large U.S. companies. And historically, you'd see a UK portfolio about 70% allocated to large UK companies.
Oh, interesting. That's what Fama used to say. Yeah.
And so that was, 2000 or so. That has begun to shift. I don't know if it's a function of getting away from commissions to fees in the country or just
they like Trump.
the free flow of information. Well, I'm sure there's some market timing in there somewhere. But even today, it's like 30 to 35% of a typical portfolio in Britain. And British companies are only like 3 to 4% of the world market cap.
Yeah.
If you add up all the values of the stocks in the world,
right.
British companies are like 3 to 4%. So that's a 10x holding of that. And so there's still a huge home turf bias, and that happens everywhere. Japanese companies are heavily weighted in large, Japanese portfolios are heavily weighted in large Japanese companies.
That is fascinating. Yeah.
And so all of that is due to behavior and emotion. That's universal. That's not limited to the U.S.
Well, it's that, that what Fama used to say was ethnocentricity. The idea we're the best game in town. We know these companies. And well, I'm talking about
wherever you are.
Every country would say that of their own, right? And Australian investors, they thought they were the best.
Well, wherever you work too. You work at GM, you're overloading GM. You work at Bush, you're overloading Bush. You work at Coke, you're overloading Coke.
Oh, I work for a major investment company, and I would have sworn to you that we were the best investment company ever.
Oh, yes.
Until I got out, and then I was like, well, you guys weren't any good.
What was I thinking?
No, I just didn't know. It was just you go to the meetings.
Right.
And you think your bank, your investment firm, and you don't recognize that, there's a whole other world out there. And, maybe you're not necessarily the best. Yeah. And it's not, and it's emotional. It's just coming back to it. That's really what it is.
So going back to the star ratings, we were talking about the plumber and the tree cutter and all those people.
Yes.
Because Angie's celebrating whatever on Angie's list. She's celebrating something because there's pictures of her back when she started. It's just referring, but it's the same thing fund companies do, Paul.
Yeah.
To get their star ratings, and they kind of, like you said, they bury their bad funds. They just kill them off. To fluff up their star ratings.
Right.
I mean, it's just crazy the amount of funds that companies sweep under the rug.
Oh,
to inflate their statistics and their numbers.
Yeah, survivorship bias.
Right.
It's we're dealing with. It's just like how do you look like the best teacher in the school? Get rid of all your DNF students. You're going to look brilliant as a teacher, and it's real. That's the way the whole world works, and a lot of people don't recognize it. And I see people. And that's why for years, Dan, we would have people bring in their portfolios, and I would look at them and I would say, well, you got all 5-star rated funds. And, I just started noticing that we had really great funds and there was nothing to pick on. And I was like, whoa, wait a minute. No, you're going to bring in a statement from 3 years ago.
Right.
And then what I would do is I would compare them. I go, look, all that stuff you own back there, you don't own anymore. And you got rid of the losers.
Right.
And the advisor did that and you don't even realize it.
Sold them when they were low. and they bought a 5-star when it was high. That's how they trained us at a big company I worked for.
Oh, yeah.
Way back in the day,
Yeah.
on the dark side.
And you are dealing with people's emotions, and that is what drives investor behavior. Yeah. So what do we do? Well, just the short of before we go to a break, when I'm looking at an investment vehicle, I'm looking at an asset class, and this came up on Channel 5, when I was on there a couple weeks ago. So, Paul, what do you do? And I said, well, I'm looking at 100 years of data. And I'm not looking at a particular fund. I'm looking at the asset category, the area of the market, because I don't care necessarily. I do care how the asset category is being captured by the fund company, but I don't care what the name of the fund company is as long as they're capturing the asset category in the way they're prescribed, which is I'm just looking at owning small international value companies, for example, where they're not stock picking. They're not trying to figure out which companies are better than others. They're not trying to market time. They're using, let's say, securities lending revenue to offset expenses. And then they're also making sure that they're using the 6 factors that we talked about, make sure that you're using momentum or reduce expenses, profitability factor. They're using the value versus growth and the small versus large and all those different factors. But, making sure that I'm getting the return of that asset category, then what I can do is I can rest easy knowing that, hey, maybe that's not an area that in the past 5 years did anything. Might have had a 0 return, might have lost money. But I own the category because historically what I know is what goes up, what goes down can go up and what goes down can go, what goes up goes down. There we go. I sound like an Alan Parsons song there, what goes up. Anyway, so that's what I'm doing as an investor is I'm just making sure because I know that long run, these various asset categories, large U.S., historic return, 10. Large international, historic return around 10. Small international, about 12 to 14. Small U.S., about 12. If I look at value, it's very equivalent between these various asset categories, but over the short run, they're very, very different in rate of return historically. And because of that, I can reduce the overall risk of the portfolio and I have more predictability as far as what I'm likely to have in the future. That's the reason that we're talking about what we're talking about here. I just want to bring it all together before we go to break. You just understand that so often what we're doing is we're getting advice on investments and they're selling us based on what asset category just did the best in the past 5 years. And it very well may be and often is the very worst going forward. And that is a terrible way to manage money. But unfortunately, that is what we see as the rule, not the exception in the investing business. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, like dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment and annuities and interest-bearing accounts and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, back here on the Investor Coaching Show, Paul Winkler, Dan Hill, and Evan Barnard hanging out here in the studio today. All right, Evan, you're up.
Yep. So we love private credit. And
what?
We do.
Wait, had your hearing checked lately, Paul? What? But that is literally out there all over the place, and 401ks coming to 401ks near you and being pushed heavily by the investment industry right now for all the wrong reasons.
It's kind of like Tronic or .com, as you say. It's like, private credit. Okay, that's going to be great.
Yeah, you need to have more diversification, which is a great word. It's a buzzword we all know is true. But
so,
anyway,
so here we go. This is from the Journal, Wall Street Journal. 2 big loan defaults add to pain in private credit funds.
No, not more loan defaults.
Software maker Medallia and dental services provider Affordable Care can't repay billions borrowed from private credit lenders, including Blackstone and Kohlberg Kravet Roberts. Two big loans that were made during the post-pandemic boom in private equity buyouts are defaulting, whacking some private credit funds and ratcheting up losses in the already troubled corner of Wall Street.
But Evan, all the rich people do this.
That's right. This is what the wealthy are doing.
That's what the sales, what the advertising says.
The people that can afford to lose the money are buying this stuff.
Exactly.
And so, software maker Medallia, a poster child for the intersection of investor concerns between technology and private capital, can no longer repay about $3 billion of loans from firms including Blackstone, KKR, and Apollo Global Management. The lenders are negotiating to take control from private equity owner Thoma Bravo, which will likely lose $5 billion it invested in the company in 2021. And so it goes to list all of these other companies that are defaulting, and you get down to where the individual can get hurt. Individuals have been pulling money out of private credit funds at a rising pace this year, and a phenomenon fund managers have blamed on irrational fears fanned by the media. They highlighted how few of their loans were in arrears. Now losses are starting to pile up.
Oh, so they were irrational until they became rational?
Right. It's the what is that phrase? Let's see. Just because you're not paranoid doesn't mean everybody's not out to get you. So,
that's really funny.
And so, we talk about this stuff kind of like we were talking about municipal bonds earlier. Is just there is no free lunch. That's the kind of the default answer to one of these things is, okay, I'm going to get this great return and there's no risk and it's liquid. Okay, there is no free lunch.
It was like that Y refi stuff that I picked on so much. And then I find that there's a big lawsuit that they ended up settling because it was a problem.
Yeah.
And then, you find out that the people that are talking heads on TV are getting paid $100,000 a month, $20,000 a month for one, $25,000 a month for another person. Then they got a new spokesperson that has come on board. Then there's another ad that I saw for something else that was promising above double-digit interest rates, risk-free. Forgot who it was. Another famous person was actually talking about this, and I went to look for information on this one. It wasn't nearly as easy as finding the disclosures on the Y refi. At least I could find the Y refi stuff like that, and I found all kinds of articles on it. But I said, they're wising up. They're getting really good at hiding the disclosures, because I went and did a search for disclosures, because I wanted to find, okay, what's the catch? Yeah. And I couldn't find it. And I thought, what chance does the regular investor have if I can't find it? What chance do they have of finding this stuff, right? And I thought, I'll just ignore that comment.
What were we saying about ethnocentric? But if I can't find it, nobody can.
Oh, no, that was not. Stop.
That's another song, isn't it?
So, I don't know. If it is, we'll write it. If it's not, we'll write it. So, for the investor out there hearing these ads on there where you don't have disclosures saying, hey, look, you could lose your back end on this thing. Or if they have the little fine print that's saying, it's subject to loss, you could have losses on this thing. And they don't read the fine print. How many investors get pulled in because they feel like they're behind, and then they get into, I gotta catch up. Oh, here's an investment that pays 12% with no risk whatsoever. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.